Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. And today we are starting with I might consider to be a very basic options trade, but this is going to be a beginner's guide to planning and placing your very first long call option trade. I can think back to when I very first started trading options and what kind of a tense moment that was. We're starting into something that's brand new, potentially intimidating. I want to try to make that as simple and straightforward as possible. The whole process, planning and placing that first call option trade. Really looking forward to this discussion. Before we can do that, though, let me first of all say hello to everybody who's already chatting in out there in YouTube. Hello there, Paul and Eva, Robert, Richard or Jay Richardson. Let's see who else is here. Lawrence and Scott and JDLMI and everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. I've already seen at least one of you chat in and say, hello, it's my first time in the live webcast. So welcome to you. Great to have you here. If you are here for the very first time, welcome. I hope that you'll put it in your calendar to join us on a regular basis if it fits your schedule. Of course, watching on the archives is great. And for those that are watching after the live stream is concluded, enjoy the recording. But if you'd like to be here in the live stream for this discussion, this is a Tuesday webcast series, and we kick things off promptly at noon Eastern time. Now, I also want to let everybody know that my very good friend Mike Fairborn is going to be hanging out in the chats. He's going to keep an eye on the questions that come in through the chat function on YouTube. If I can't get to those questions, if I can't address those, Mike's there to pick up my slack. As long as the questions aren't too far off topic, Mike will help out. So thanks for having my back there, Mike. And Mike and I would like to issue an invitation to everybody watching or listening. Follow your favorite Schwab presenters on social media. Great place to connect with us when the cameras aren't on. So you can find Mike and me on X. You can follow Mike. His handle there on X is at Mike Fairborn CS. Mine there is at Cameron May CS. And now, as of about a month ago, you can also follow me on LinkedIn. So just go to linkedin.com/in. and then my handle /Cameron May CS. All right, but let's get into this discussion. I recognize, when we first start learning about options, one of the very first words that we encounter is risk. Yeah, options carry a high level of risk and are not suitable for all investors. So please do bear these risk disclosures in mind. Now, Schwab does not recommend the use of technical analysis as a sole means of investment research. And investing involves risk, including the loss of principal. But when we first learn about options, I think that initially traders learn about the leverage that's potential through options, the risk that can be associated with that leverage. So planning and placing that first option trade can be kind of a high stress moment. Now, we have the opportunity here using Thinkorswim Desktop to use a paper money platform to do essentially practice trades. That's what we're going to be doing today. But we're going to be planning and placing from the perspective of a brand new option trader, their very first long call option. We're going to buy it. We're going to be planning when to sell it. We're going to discuss how much we can make and how much we can lose and the circumstances under which those sorts of outcomes might play out. So here's what we're going to do today. I have an example stock prepared that we're going to be trading an example long call option on. So we're going to talk through the phases of planning. How do we pick a stock? How do we pick which option to get into? When do we buy? When do we sell? And then how is the order placed? So that's how we're going to go through today's presentation. Let's go right to the Thinkorswim Desktop platform. And the stock that I've selected for today's example is Walmart, right? So this takes us immediately to the very first question that a trader might ask themselves as they're planning and placing their first call option trade is what kind of stocks might we trade options on? Because there are tons and tons and tons of different potential stocks that we might choose to trade a long call on, but there are some considerations that the trader might have in mind as they narrow that field of potential candidates down. And as a matter of fact, just this morning, I was going through the YouTube comments and I wrote out kind of a lengthy explanation for someone who had asked a question related to this. The problem that they were running into was getting out of options contracts that they had gotten into. They were running into liquidity issues. That's a big concern with a lot of options traders. So let's lump that in. include that in the consideration. So what kinds of stocks, generally speaking? Well, buying a long call option is a leveraged bullish position. So however a trader qualifies the idea that we're buying a call option on a stock that we think is going to go up, that probably is going to make the checklist. So it might be that the trader is focused on a specific sector that they think is going to do really well in whatever today's economy might be. They may see something on the chart that looks particularly encouraging, but a couple of final considerations are the price per share on the stock, but also the liquidity of the stock and its options. If a stock is illiquid, its options tend to be even less liquid, and it can be hard to get in and frequently even harder to get out of those. So some of the answers that I gave to that person asking that question is, if liquidity is a concern, maybe make sure that we're only trading stock options on some of the most liquid stocks out there, those with potentially the highest market capitalization. Those tend to be the stocks with the highest trading volume. And when I'm talking about liquidity, I'm talking about trading volume on the stock and on its options. So for those reasons, not necessarily for the sector reasons, but for liquidity, for price, and for what's happening on a chart, I selected Walmart as today's example. So let's take a look at that chart. What's going on with Walmart? What might a potential long call option trader see on that chart that might be intriguing? Well, they might notice that over the course of the last, about 5 months, Walmart at times has really spiked up in price, going up about $10 each time. Notice here back in July. Ooh, that's interesting. July 11th. That's my birthday. Hey. But starting right there about July 11th, the stock ran up from about $94 up to about $104, about a $10 run here. And then we pulled back. We hit a low around 95 and ran up to about 105. Obviously with some rounding here. I'm using that for convenience for the discussion. Pulled back again down to about maybe $100, maybe 99, and then up to about 109 or close to 110. And then most recently, we hit lows around 99 and up to about 109. Interesting. So traders very commonly will look at historical tendencies in stock price behavior as an effort to try to gauge what the stock might do next. So if we use that as a context, there's certainly no guarantee here. If this stock has had a tendency, though, to run up at times about $10, well, what's happened recently that might incline a trader to think that that might be about to happen again? Well, recently we've come down to a previous price ceiling, right at about that 104 level, 104 here, here, and here, that just over the last 48 hours, that might be a new support. You'll notice we've come down and bounced off that apparent previous price ceiling, could be acting as a new price floor. So Paul says a possible bounce off what we'd call support or a price floor. Yeah. So if this is starting to run, and if that floor turns out to be that 104 level, where might the trader anticipate the stock might move to next? Obviously, it's just an estimate of what might happen in the future. It's not a guarantee. Let's say that our trader thinks that we're going to go from around 106, which is where we find ourselves now, up about another $8 still left in this possible journey from 104 up to, let's say, 114. Now, if we think the stock is going from 106 to 114, a trader might choose to just buy the stock, but that's not what we're doing today. We're going to be buying a call option. A call option it's similar in some ways to buying a stock, but very different in other ways. Instead of buying the stock, we're going to enter into a contract for the right to buy the stock. So let's talk about exactly what a call option is. So let's come over here. And here is a call contract. Some of the elements of a call contract. Number one, we are securing the right to buy shares. And typically, on what we call a standard contract, it's to buy 100 shares. Now, that's not going to come for free. Instead of buying 100 shares outright, what we're doing is entering into a contract with another trader out there in the trading universe somewhere where we're securing from them a promise that they will sell 100 shares to us at any time for a specified price. Now, they're not going to do that out of the kindness of their hearts. Instead, we're going to be paying what's called a premium, not a remium. Let me get the P in there. We're going to pay a premium, or in other words, this is the per share incentive that we're paying to another trader. So, for example, on Walmart, let's talk about this. With the stock trading at 106, let's say that we wanted to, instead of buying the stock at 106, let's secure a contract that allows us to buy the shares for about that much. All right. Let's go to the trade tab and start to look at the realities of available contracts on Walmart. This is real-time stuff. Now, it's just paper money. We're not going to be placing an actual live trade, just a practice trade, but it's using real-time quotes. So as we look down what's called the option chain on the trade tab, we can see contracts that run through any lengths of time. So we're going to be paying a premium for the right to buy 100 shares for a specified amount of time. In other words, there is an expiration attached to this trade. So there are some contracts that run for just 3 days. As of today, today's November 25th. It's a Tuesday. These contracts expire, or they run through the 28th of November, which is just 3 days away. That's Friday. Now, there are also contracts that run 10 days, 17 days, all the way out to, yes, we could enter into contracts for 787 days on Walmart. It's not going to be exactly the same for every stock. You just pretty much have to bring up the option chain and look to see the contract lengths. But yeah, through the 21st of January of 2028, right? But how about, let's talk about selecting which time frame that the trader might choose. And this is where that chart might come in doubly handy. Number one with the chart is it might assist the trader. Well, it's sort of triply handy, I guess. It might assist the trader with the timing of their entry. And buying off of potential price floors is one potential way for a trader to time their entries. It's not a guarantee, but it's a common approach. So that's one benefit. Using previous moves, it's called a measured move for obvious reasons, but using previous moves to project how far the stock might move on this move, that's a second potential benefit of a chart. Now, a third is a time frame. So we have this whole sort of bulletin board of potential contracts we can get into, some for just 3 days. And even if you're brand new to this, let me ask you, does 3 days sound like enough for what we've been looking at on Walmart? Do we think that it's likely, based on recent history, that even if Walmart goes up, that it can go all the way up to 114 in 3 days? That's our time frame? Probably not. So a third potential benefit here of using charts is we can gather a sort of an estimate of how much time we need on the contract. So if we look at these past 4 moves, this one was almost a month. That was about a month. This one was more like a week. So, and the other two were sort of in between. Maybe this one was 2 weeks, maybe this one was 3 weeks. So somewhere between a week and a month. 3 days probably is not going to cut it for this trade scenario. Now, to the opposite extent, 787 days might be a little overkill. So here's a rule of thumb that some traders might use in the selection of the time frame of the contract, and that is they might look for a contract that offers twice as many days as needed. So if we're looking at, all right, maybe this move could take up to a month, maybe the trader looks for at least 2 months, but not a lot more than that. So here we look at the 16th of January. That's more like, that's close. That's a few days shy of 2 months. This one is a couple weeks, maybe a few weeks beyond 2 months. Let's say that we go for the 20th of February of 2026, and that, using that chart, might assist us with selection of the expiration on these contracts. So let's get back to the details of the contract, and let's strike a deal with someone else. So let's acquaint ourselves with the layout of our option chain a little bit further. And as a matter of fact, I kind of cheated. Let me go back just a step, this is what you would see on first glance at the option chain. What you'd see are essentially 4 columns on the left, 4 columns on the right, and then a couple of columns down the center. So let's talk about these center columns for just a moment. This one is just telling us the expiration of these strikes. This one is telling us that the prices at which we could strike a deal to maybe buy shares from another trader. So for example, with the shares of Walmart trading at 106, we could look at, let's say, the 105 strike. So you'll see this is titled strike. Well, if I were to choose to buy a call option with a strike price of 105, that would literally translate to I'm striking a deal with another trader where I might choose to buy 100 shares of Walmart from them for $105 per share. So we have an expiration, but we also have a strike. Okay, so let's start to outline these for today's example. Let's say 105 for our strike. Our example expiration is going to be the 20th of February. What would it cost me as a premium for the 105 strike? Looks like if I look over here at our column, at our left column, the right columns are our puts. We're not going to be dealing with those today. As a matter of fact, we had a discussion of planning and placing your first put trade last week. So if you want to see that presentation, you can just go to our YouTube channel. It's called Trader Talks Schwab Coaching Webcast. So do yourselves a favor. If you haven't subscribed to our YouTube channel just yet, do that right now. It doesn't cost anything. You just go down below the video stream, click on the subscribe button. But this is where we house previous playlists or previous webcasts organized into playlists, but you can also join our live streams right there. But for example, I could go to playlists and I could just scroll on down. Mine is right toward the bottom. So if I go right down to the bottom, there's my Getting Started with Options full playlist. I could click on that, and you'll notice right here, planning your first put option trade. So if you want to check that out, that's available. In any case, let's go back here to our contract that we are outlining. And how much might it cost us to incentivize someone right now to enter into this crazy contract that we have in mind? We want someone else essentially to give us the right to buy 100 shares of Walmart from them at any time for the next 87 days. It's actually not 2 months, it's closer to 3. But any time in the next 87 days through the 20th of February, we want the right to buy 100 shares at 105. And they just, if they enter that contract, they have to deliver those shares on demand, on our demand. So they're not going to do that for free out of the kindness of their hearts. Instead, we're likely to have to spend somewhere between $5.95 per share and $6.10 per share as essentially an enticement to the other trader. We're paying them for that right. Let's say that's $6. That's $6, and I'll throw per share on here just to make sure that we're being explicit, right? Now, these things in parentheses, just so you know, these are just examples. These are not the only choices I might have made, but I'm making these for specific reasons. But anyway, so there's a final element of this trade. And this is one that I kind of overlooked when I first learned about trading call options, and it made me very nervous. But this was very reassuring. This deal is what we call transferable. What does that mean? So if we pay the $6 per share for the right to buy 100 shares for $105 at any time between now and the 20th of February, that's great, but we're not stuck in this trade. There's a deal attached to these options that allows us, if we decide to, we can offer to sell this contract to someone else. Now, maybe for more than we paid for it, maybe for less than we paid for it, but sell this contract that we bought to get into. We can choose to sell to get out of it as long as it's liquid. That's why I talked so intently about liquidity here. Yeah, transferable means that we can pass it along to someone else. And in this case, it's just through the market process of buying and selling. So to get back to early Cameron learning about option strategies days, what that meant was I'm not stuck necessarily in this trade. I always have to throw the necessarily, because if I buy into something that's highly illiquid, it can be very difficult to get back out. All right. So those are the details of the contract. So there are lots of contracts that exist out there that can be highly complicated. At least in my view, this is relatively straightforward. But boy, this delivers a pretty powerful package to this trader if they choose to place this trade. As a matter of fact, I'm going to go ahead and place a trade. So right now, while we are seeing a quote now about $6 to $6.10, might cost us a nickel or a dime more than $6. I'm going to go buy one call contract as an example. So let's place that trade. So the process for placing an option purchase order is to find the strike price that we're interested in. I'm going to click on the ask price, and that creates a buy order. It just pops up. And the default is to get into 10 contracts. I'm going to change this to 1. Okay. So we're going to put an order to buy it's just a single leg contract. In other words, there are fancier option strategies where we might use what we call multiple leg strategies. This one is just buying a call, not in combination with anything else. One contract of the Walmart 20th of February of 2026, 105 strike. It is a call contract, not a put. And a default price, the limit order here has been set to 610. When we submit what's called a limit order, we're saying this is the most we're willing to spend to get into this contract. That's my limit. Now, a helpful little slide bar appears down here where we can move that price that we're offering around a bit. I'm going to leave it right at 610. But for example, sometimes a trader will say, well, I'd like to pay somewhere in between the bid price and the ask price. And by the way, why do we call it bid and ask? Well, we use the same terminology as we do for when we're trading stocks. If we are buying something, if you want to buy a house, you go up and you ask the homeowner, hey, how much are you asking for your house? And they say, I'm asking $500,000, and you pay the $500,000 or whatever, right? But you pay the asking price. If we're selling something, we might say, hey, I have this item for sale. How much will you bid for it? And then we sell to the highest bidder. That's sort of what I think of when I'm thinking of the terminology bid and ask. So buyers typically pay at or close to the ask price. Sellers typically receive at or close to the bid price. And the mid is halfway between the two. Sometimes when an option trader or a stock trader is trying to get a little better deal on their fill, they might demand, hey, get me filled at somewhere in between, or don't fill me. We could do that by lowering the price that we're willing to spend here. I'm going to dial this up to what's called the natural, basically offering to pay closer to what we'd consider the market price of the stock. All right. But this is going to be our contract. So notice, how did we do that again? Just click on the ask price, and that creates almost a complete order. We just need to customize it as we see fit. And I'm going to click confirm and send here. Let's see if we can get a quick fill on this long call. So we're going to buy the Walmart 20th of February of 2026 105 call for a 610 limit. Let's see if we can get filled. Interestingly, this tells us how much we can make or lose theoretically on this trade. I'll come back to that. But do make a note, how much can be theoretically made? An infinite amount. That's true. How much can theoretically be lost? The full investment amount. At $6.10 offered per share, 100 shares is $610. Now, there is a commission to be paid on options trades, so add 65 cents to that, so bringing our total cost to enter this trade, $610.65. I'm going to send that off. And let's see if we can get that filled. That's going to be one of our working orders now. Oh, yeah, looks like we filled at 605. Okay. So we just spent 605, but we haven't answered all the questions I wanted to address. I wanted to talk about the kinds of stocks that a trader might choose to trade long calls on, which expiration they might choose, when they might choose to buy that long call, and that can come from potentially what they see on the chart, on a stock chart. But I kind of randomly chose the strike price, 105. Well, that's close to the current price of the stock, but is that how the trader always chooses options? Every once in a while, I'll hear somebody say, don't we figure out where we think, if we think the stock is going to go to, let's say, 114, don't we just buy a call option that's close to 114? So in this example, that might be around 115. Nope, that's not necessarily the way it's done. Because if we revisit the terms of this trade, what does this give us? If we were to buy the 115 call, we'd be paying around $2, maybe $1.95, close to $2, for the right to buy 100 shares, 115 bucks. Now, if the shares go to somewhere close to 115, we then have the right to buy the shares for basically what they're worth. Does that sound like an amazing accomplishment? Not necessarily, right? So how does a trader choose the strike price? So here is a basic set of considerations. If we look at these strike prices, just remember what we're doing. We're paying for the right to buy shares at that price. So we can pay for the right to buy shares at lower prices. We can pay for the right to buy shares, yes, even at higher prices, which initially doesn't sound like it makes a lot of sense, but it certainly can. But the lower the price that we would like to strike a deal to buy the shares for, the more we have to pay for that deal. That just makes sense. If we want someone to sell shares to us for $95, we're going to have to pay them more money to incentivize them for the discount they're giving us on those shares. Now, on the other hand, if we want someone to give us the right to buy shares for more than they are currently worth, there's not as much risk to that trader, and therefore we don't have to pay them as much as an incentive. So why in the world would someone ever choose to buy a long call, to buy it? When I say long, by the way, that just means we're buying something to initiate a trade. Why would I ever buy a strike price of, let's say, 115? Well, if the trader expects the stock to move explosively, it can make sense to do that, because let's say we buy the right to buy the shares for 115, it only costs us a couple of bucks, and then those shares go to 120 or 130 or 140, and we have a contract that allows us to buy the shares for 115. So it's not how much of a discount we're getting right now, it's how much the trader thinks they're going to have as a discount on shares in the future, right? So there's a sort of teeter-totter effect. Yes, we might be motivated to pay more money to have the right to buy shares at a lower price, or sometimes a trader might want to pay less money to buy shares potentially at a higher price. Now, Eva, thank you for pointing this out. I always appreciate that. Let me hit pause on the presentation here for just a moment, because for those who are here in the live stream audience, there's a survey link that's just been added to the chat window. So if you do me a favor, each time you see a survey link pop up, just make a habit, click on it. And then you can fill out that survey when the webcast is over, and you can give us honest feedback. I'll just let you know it's a really short survey, and I read through that data. When you fill out the survey, I read through the results, I read through the comments, the suggestions. It always helps. It's never wasted effort. All right. So thanks for doing that, guys. Definitely appreciate it. Thanks for calling it out there, Eva. But so now we've talked through the stocks that a trader might choose to trade options on, when they might choose to enter the trade, which expiration they might select, how they might choose a strike, or which, the pros and cons of strike selection, because there can be right or wrong based on the preferences of the individual trader. But we already own this right. We just paid, it wasn't let's update this. We actually paid $6.05, right? Paid $6.05 per share for this contract. I want to talk about how much this trade might make, how much this trade could lose, and when we might choose to take profits or losses, right? So let's talk about the fun part first. How much could this trade make that we just entered into? Let's go have a look at our chart and let's run a hypothetical here. Let me give myself a little bit more headroom on a chart. I can just right click on this right margin, drag it down a little bit, and let's draw in a line up here at 114. That's about right. Let's say right there, close enough. No, I'm going to edit it just to be sort of nitpicky. 114. There we go. So if our stock were to rally to that level, let's say we're at 106.5 right now, and our stock goes up to 114, and it's before the 20th of February, what might the trader choose to do at that point? Well, boy, we would have the right to buy shares that are worth 114 bucks, and it would only cost us $105 to buy those shares. That would be a $9 value. That would be pretty impressive because we only paid basically $6 to get into this trade. That would be a 50% gain minimum. Actually, that would be I can say that quite confidently. The minimum value of that contract at that point would be $9 because it's providing a discount of $9 per share on 100 shares of stock, $9 of value. However, if we made that move relatively rapidly, there would be even additional value there, because let's say that we got up there and it was, by, let's say, the second or third week of December, and we have the right all the way out through the 20th of February to buy those shares. Well, we might choose to sell that contract at that point. We bought it for $6. I'm doing a little bit of rounding there, but basically $6. And we could then say, hey, everyone else, I have the right to buy this $114 stock for $105. There's a $9 discount, and you can buy that discount from me. Even better still, there's still 2 months left on this contract, and a stock that's moved up that far that quickly, could it go further? That remaining time carries additional value for the potential new owner. So selling that contract, we could just say $9 is the minimum value that might be sold for under those circumstances. So that's how much could be made. So at least 50% if we get to our 114 objective. But that's not the most that could be made. Because where could this stock actually go? What if we just decided, let's just hang on to it? Maybe we got up to 114 pretty quickly. What if it then went to 115? We're still waiting for the 20th of February. Stock goes to 120, 130, 140, 150. I'm kind of getting a little bit ridiculous here, but it's still within the realms of possibility. When we buy a call option, there's actually unlimited upside potential on that contract, because between now and the 20th of February, there is no cap on how high the stock can go. We don't know if the stock goes up, how far it might go up, and therefore unlimited upside potential. Don't want to get too excited about that, because I haven't ever actually met an individual who has realized unlimited upside potential, but lots and lots of upside potential, yes. All right. So I have a question here. What if you want to purchase more than 100 shares at the $6? How do you know if the seller has more? Well, the question there would be, if we wanted not access to buying 100 shares, maybe 200 shares, maybe 300 shares, we might just buy more contracts. Yeah. So a standard contract is traded in lots of 100 shares. That's how much the standard contract represents, right? So we don't have to have perfect insight in what the other person has. Here's another thing. It's natural to ask this question: what's going on in the mind or the account of the other party involved in this transaction? It's not really important to the discussion any more than knowing what's going on in the mind or the account of the party with which we're buying and selling shares of stock. For some reason, I know that an options trader, we'd like to get deeper insight into that. Not terribly important to know, but it is important to know whether we're dealing with a liquid marketplace or not. And so one big cue regarding whether a specific contract has relatively strong or relatively weak liquidity is to look at the distance between the bid price and the ask price. And one rule of thumb is to look to see is it less than 5%, right? That would be generally considered to be highly liquid. Another tip off is if it trades in pennies. So you'll notice, let's say the 115 strike price, 191 and 196. It's not like a big round number like some of these others. The strike price that we chose to buy, we have a 610 bid and a 620 ask. There's about a 5 or a 10 cent spread on a $6 contract. That's not a big difference. Now, if we look at some other strike prices, let's go up here to maybe the $85 contract, 2280 by 2080-ish. There's about a $2 spread there. That's closer to 10%. For some traders, that's kind of pushing. That's an indication that there's not quite the liquidity there. So, and by the way, Shane says you have a question there. Yeah, sorry. Yeah, I won't be able to address that one here. In any case, that's a quick way to check liquidity. If there is a narrower spread between the bid price and the ask price, because the function there is there's a party or a person behind this accomplishing or providing a marketplace for between the buyers and the sellers, known as the market maker. And when there are very few buyers and very few sellers, there's poor liquidity. They will tend to spread the prices between the bid price and the ask price further apart. That's an indication of that illiquidity. When there's lots of liquidity, lots of volume, lots of buyers, lots of sellers, you'll see that bid and the ask tighten together. All right. All right. So we're ticking most of the boxes here. How much can we make? It's an unlimited amount. How much can we lose? We can lose the full invested amount. Let's say that we pay the 605 for the right to buy 100 shares for $105 and the stock collapses in value. Let's say it goes down to $100, $95, $90. And at expiration, the shares are only worth $90. And we are sitting there holding a contract that gives us the right to overpay for those shares. That doesn't have any value. And there's no time left for recovery of that value. In that case, the contract could just expire worthless and we lose the full 605. So let's talk about a potential final element of this trade. Now, this is a beginner's guide. There's still going to be certainly more that a trader can learn about trading long options, about long calls, but we've learned a lot in our discussion together today. Let's talk about a couple of reasons why the trader might choose to exit the contract. And what I will say is that in most circumstances, the trader isn't actually buying this contract with the intention of ever buying the shares. Instead, the typical objective is to buy the contract, wait for that contract to go up in value, and then sell the contract itself for more money. So for example, if we go up to 114 and the contract's now worth at least $9, and we only paid $6 for it, maybe we just sell it then. Cash in our 50-ish% gain, maybe more, and be on to the next trade. Or if the stock doesn't go up, if time is ticking by, the stock's not moving, maybe it's going down and our contract is losing value rather than gaining value, maybe the trader just decides to cut their losses, take their lumps, and exit. So let's put in an order to exit this trade. Let's say if our contract goes up to 114, or we'll put in an order to get us out if the contract loses, let's say, half of its initial value, right? So let's do that. Let's go to our monitor tab. Let's find our contract. So this is Walmart. Here we are on Walmart, right down here at the bottom. So monitors where we monitor existing positions. And I'm going to right click. This is one way to put in exit order. Go to the monitor tab and right click on the position, and we can create closing orders from there. Now, I'm going to modify this closing order. Let's choose to sell this contract. We don't want to sell it right now. We'd be basically breaking even. And as a matter of fact, there are two conditions under which we might want to sell, with a profit or with a loss. So I'm going to give myself the ability to put in 2 orders. But if one fills, we're going to cancel the other one. OCO, one cancels other. Okay. So let's put it in order here to sell. And let's say we want to sell under the condition, over here to the far right is where we can enter conditions. Let's say we want to sell at a condition of, actually, let's just do it this way to keep it simple. Let's sell if we can get at least $9 for this contract. Okay. That'll be our limit, our minimum acceptable profit. I'm going to make sure that's a good till canceled order. Now, at the same time, let's right click on that and create a duplicate order to sell under a different condition. And this condition is, well, if the stock isn't, or if the contract isn't growing in value, let's say if it's shrinking in value, let's stop the bleeding. We're going to put in a stop order at, let's say, a $3 value. So we'll sell and take profits if we can get out for 9, sell and take losses if we have to exit for 3. Both of those, we're going to enter a good till canceled order. I'm going to click confirm and send. And that's going to do it. Sell the call at a $9 limit, or sell that call at a $3 stop. Now, relating to stops, we have to remember those are not a guarantee. If the price is falling and it's falling hard, we might sell for less than $3. That's just essentially a trigger or an activation price. Okay. And let's click confirm and send as we do. If these orders are filled, if one of the orders is filled, because they won't both be filled, one of them will cancel the other one. If we sell for 9, selling for 3 is canceled. If we sell for 3, then selling for 9 is canceled. But in those conditions, though, we would be paying a commission to close. Let's send that order off. And we now have a long call with unlimited upside potential, but we just put a kind of a cap on it, put it in order to sell at 9. We also put it in order to sell at 3, and those are now working orders sitting right up here, waiting for execution. And right now, the stock is trading, or the contract is trading for $6.10. We paid $6.05, so we're up a nickel at this moment. But guys, that is going to do it. That's the beginner's guide to trading long calls. I hope that was an interesting discussion for you. It's always a little bit of a tense moment when placing that first option trade. So nice feature of Thinkorswim is that we can do simulated trading. So when learning new strategies, it might be a good plan to go do some practice trading first. See how they play out before the trader considers, moving on to live trading, if that's ever going to be the case. So everyone, that's going to do it for today's discussion. I definitely appreciate your time today. This is what we do on Tuesdays. We just learn about getting started with options trading. So I hope that you'll put it in your personal calendar to join us in live stream or watch the archives. Do make sure, though, if you haven't subscribed to our Trader Talks channel yet on YouTube, do that. You can just go right down below the stream, click on the subscribe button. It only takes a second, but this is where we house our playlists, and you can join the live streams right here. Now, another thing that Mike and I would suggest you do is to follow us on social media. You can find Mike and me on X. You can find Mike there at Mike Fairborn CS. You can find me on X at Cameron May CS. Just give me a follow there. And then if you reply to one of my posts, I just try to reply right back to you. It's a great place to connect with us when the cameras are on. You can also now follow me on LinkedIn. Go to linkedin.com/in, and then /Cameron May CS is my handle. That'll take you right to my profile, and you can give me a follow there. That's brand new, so I just have a handful of followers there, but I'm posting there frequently as well. And if you reply to the posts there, I try to reply right back to you as well. But guys, thanks for giving me your time today. Definitely appreciate it. Go fill out that survey if you would. I will definitely read through your comments. I read through that data. It always helps. And also thanks to everybody that's already clicked the thumbs up. If you have enjoyed a webcast from your Schwab presenters, make sure that you click that like button. It's like a pat on the back for the presenter, but it also gives us a boost in the YouTube algorithm so more people can find these videos and learn about things like planning and placing their very first long call option trade. All right. Everybody, thanks a lot. I will see you in a future webcast. I'll also look for you on social media on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.